What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is January 15th of 2024. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I not only want to spend some time to break down the really bad weekly close we just had here at the start of the ETF launch and at the beginning of the new year. But outside of that as well, I want to spend some time to dive into a whole range of altcoins that are starting to signal that they're overbought in the near term, that the trend is weakening, and where we could possibly find some entrants. And outside of that as well, on the macro picture, I want to talk about what's going on in equity markets and the great concentration of equity value into the top 10 stocks in the S&P 500 and how this could pose a big problem for equity markets going into the hopes of a new bull market. We got a lot to unpack here in today's video, so if you happen to enjoy it, consider dropping a like. And I understand I don't have my normal computer here. I am in the normal office as per usual, which some people believe is my mom's basement. That's not true. But let's go ahead and kick things off, guys. I know I told you guys I'd have a surprise for you here today. There's a little bit of a delay. We're going to have that surprise ready for you guys on Wednesday. So let's just go ahead and kick off the market analysis here. Now, I want to start here by talking a little bit about what's going on with Bitcoin's price. We've not only had a couple of days where Bitcoin, especially throughout the weekend, has been trending below the 21-day. This is the longest period of time since we really started trending above the 21-day back here in October and really making that significant price appreciation, which is already a bad sign as is. But if you take a look at how price reacted into the ETF news, this played out like a typical buy the hype, sell the news play here. And while we didn't get an absolute flash down here to the 200-day, something like that's not going to happen on day one, and that's usually not how it plays out throughout history. This is a telltale sign that we likely need to come back down as we've broken through the 21-day. The bulls have lost control here. We're at the same price range we were at back here in early December, so we've cut out a month's worth of price appreciation. And outside of that as well, the trend is simply just stalling here and looks like it's ready to come back down and have a healthy correction to the 100-day pocket, the 200-day pocket, some of those long-term moving averages that we signified over the past few weeks. Again, I don't think that this is, again, a doomsday or overly bearish take. Bitcoin has made a significant move here over the past few months since back in September. And while it's not something that I feel, we're upset we missed or anything, at the same time, this is definitely having a weight not only on the impression of where Bitcoin is heading into the next few days, but also for altcoins as well. I'll go ahead and just kind of put it in perspective here. If you're someone, for example, who bought Bitcoin at the open, I'm not even talking about where it popped up to during the initial trading day, Bitcoin is down 10.66% since the ETFs launched back 2 trading days ago. So it's important to understand and keep that nuance in mind that when new investors or new capital are looking at this, they may think, I need to step back for a bit. I need to wait for this to start trending a bit more sideways, consolidating a bit. And this is, again, going to mimic Bitcoin's price. So until Bitcoin starts to do that, one of its moving averages, I think a lot of smart money is not going to be touching this right now. And the other thing as well that I would say to keep in mind is a lot of people believe that there was massive demand on day one for the ETF. But an important nuance to consider here is that in the first 2 trading days of the IBIT ETF being live, this is the iShares or BlackRock ETF, they only have around 2,600 Bitcoin worth of shares created or custodied under the holdings. So that's around 200 million, which is definitely a solid amount out the gate. It's not bad, but it's not the billions of trading volume that people were maliciously sharing as almost as if that was the amount of holdings of the ETF, which is just not true. It's just trading volume. And you can see that the majority trading volume and majority of holdings is still in GBTC, which has been live and trading here in the market for coming up here, I think, on almost a decade. It's been around for a long time. So I just wanted to, again, consider that nuance here, but focus in on where we're more interested, which is altcoin markets. I think altcoins, especially in the narratives that we're excited in, that have been leading the way forward and have been one of the surefire bets here over the past few months, are starting to look a little bit overbought in the near term. And it may be that throughout Q1, going into halving event, we see a lot of these plays continue to pull back and cool down. One of them is Stacks. This has been a play I've been watching. We talked about it since it was around 60 cents. We've actually covered Stacks for a long time on the channel, but really we started talking about it back here in October. as it was coming this support line here back in September and starting to build back up and get above its moving averages. Plus, it's a strong play as it's a Bitcoin-related infrastructure play for programmable smart contracts, where BTC is the native currency. But the main point I wanted to signify here is that it's climbed up from 60 cents at the first time we talked about it all the way to $2. And at the end of the day, I think Stacks long-term has a long way to go, and it could come up if we really get a full swing bull market and come up and test this ascending line of resistance, as it did here with the ascending line of support. But that doesn't mean it's going to happen overnight. And we take a look here on the weekly. We got an ugly weekly close here. Basically a solid 15-20% fade here on the wick on the top of the candle. And you can see here along with that as well that in March we had similar candle structure, nice multi-green week setup with very few pullbacks, and then a clear weekly resistance here, a snap below the 21-day, and that looks exactly like what we're having right now. And we're going to surprise it's barely holding on that 21-day. And if you get a solid red close here down to say 150 or 145, that's going to be your telltale sign that this is probably coming down here to the 100-day or 200-day moving average. And that is going to be much more favorable entry. Doesn't mean you have to wait around for that. You can be dollar cost averaging into plays like Stacks if you believe that this is really going to go off and do that big rally. The point I would say, though, is use a means of passive dollar cost averaging, but accelerate that dollar cost averaging the more it corrects. So my point here is that you can get a lower average entry if this continues to pull back, but even if it doesn't go all the way down to the moving averages, at least you've got some position. You can continue to take that additional capital that you might have and average in as it's starting to trend higher and show positive signs in price, right? So there's some ways you can play this that are much smarter than just blindly dollar cost averaging into the market. Outside of this, well, ordinals. Ordinals, just again, not even trending here, just holding on that 21-day. And if that snaps, you're coming probably down here to the 100-day at a minimum to $43, right? It's not a full 50% correction, but it's definitely well over a 50 to 75% correction, somewhere in that ballpark, a steady pullback from that price point. So we have to keep that in mind here when we're watching these plays that aren't really trending, but are just barely holding here on some of these plays, right? As we go down the list here into the 100-day pocket and 200-day pocket, you could really see ORDI starting to correct big time from this range. So it's important to keep that in mind here as we watch towards those moving averages as potential entry points. And there, as you get closer towards them, you have much better risk-reward setups on some of these different cryptocurrencies that we can trade. Wanted to take a look at Total 3 for a broader trend, because some people might say, Nick, okay, you focus a lot on Bitcoin infrastructure, and I'll also take a look at meme coins here in a minute. Those are kind of the two big things that I've been focused on. What about Solana? What about the other L1s out there? There's a lot of L1s that are popping off from time to time. Yeah, there's one L1 that comes out of nowhere and does well one day and then it fades its gains. If you look at a broader trend here across the board for market cap in Total 3, you'll find that we've been trending sideways since late December. And we are now very much clearly facing resistance at the 21-day, which used to be clear by the dip support before price continued to accelerate. So this is your first telltale sign here that we should be a little bit more cautious before we get totally euphoric going into altcoins at this range. And it's, again, not me being bearish or saying it's going down to new lows. I know some people love to say, even though like we haven't had this ultimatum for a long time, or it was just a general target we kept in mind. A lot of people say, oh, Nick's calling for Bitcoin to go back to 12K and altcoins are going to go to new lows. No, I'm not saying it has to do that. What I am saying here is that it's clearly not holding on the 21-day, right? And as much as some might want to argue that, it's a clear sign here that the trend is slowing down. You can use these averages as a means of showing you, hey, what happened over the last 21 days? Well, really, for the last week or two, the last 21 days have yielded nothing new, nothing exciting. And that's not a good sign here. That's the first sign you see if we just zoom back here before corrections, right? When you see those moving averages starting to go down, it's usually indicative of a longer term trend, right? You saw that here, you saw it back here, right? As we went up here, we had some slight pullbacks. Notice that 21-day just slows down, but it continues climbing here, right? So we're not seeing any serious decline when there is accelerated trends where the bulls are confident in holding things true. All right, now let's take a look here at BONK as well as Bob, the meme coins we've been watching. Again, I know it sounds silly, But these are the plays here that are trending the market and making sizable returns. We can't fight the trend. We can't fight the narrative. That's what the market's got its attention on. And in an industry that is really lackluster when it comes to new DeFi technologies or things that are exciting, doesn't shock me. What we can see here is that while there might be an attempt here for BONK to hold in that 21-day, like we talked about with ORDI and some other plays, it's struggling here. So watch what happens here. Unless we get a nice solid green bounce off that range, this is probably coming back down into the 100-day pocket or the 200-day pocket, which I think would actually be a much better foundation here because you've got this prior range here of support before the rally continued. And I think if you could get ORDI down there, I mean, again, that's quite a hefty correction. It's around 88%. If ORDI does something like, a BONK does something like that here and comes down to that range, that would be, I think, a phenomenal risk-reward entry where you can have a nice 20% stop set below that range, somewhere along that range and stuff. You don't have to follow exactly what I'm saying, guys, but somewhere in that range, you get nice solid double-digit, stop loss price levels below your entry, and then from there, if this thing just starts to skyrocket, you have a much better risk-reward framework here to work with than trying to enter in up here, where we're just back where we were on December 9th on this meme coin. Not to mention, again, this is a purely speculative play. Same goes here with Bob, guys, with these meme coins. You've got to be careful here. These are highly speculative plays in the market, and you've got to be very tough about setting in your entries. And yeah, sometimes you're going to miss some opportunities, but at least you're not going to burn yourself. You're not going to get over leveraged. You're not going to get liquidated. You're not going to basically get completely nuked on your portfolio going all into a meme coin without any risk management. It's okay to have your stop hit. It's okay to take a little bit of losses. Just simply don't just go all in and just feel confident knowing that it's just gonna go up. There's no guarantee of that. I think another one as well, as we talked about, I know a lot of people we started to have some people asking about Bob the other day as it started to pick up here from around the 23,000 point range here to 40,000. Again, the decimals are so small, but you get my point here. Generally, we've been talking again about setting our standards a little bit higher here, that we're going to get a pullback towards this range. We failed to hold the 21-day. I think this is again a broader indicative trend of the altcoin market. And what do you know? You've got the 200-day and the 100-day pocket right down here, just screaming for Bob to come down into this range. I would love to see it holds at that range, accumulates well, similar to what we saw back here. And then eventually, as that 21 days coming down for us, unlike last time where we got shot down, to see whether or not we get the momentum for this to really break out and see this thing just rip higher here, especially if ETH becomes the narrative. Bob is a ERC20 token meme coin, so that's something for me that really interests me in the same way that BONK was taking off during the Solana ecosystem, getting a lot of attention. All right, I want to go ahead here, guys, talk a lot about the topic of concentration. We talked a lot about what's going on in equities. Actually, there's one last thing I want to talk about with crypto. I apologize. The one thing I want to talk about with crypto here, as I know some people have been talking about, the entrance of new liquidity. One thing we haven't been visiting much as of recent is stablecoin liquidity, as we've been really kind of focused in on what's going on with the ETF. But if we take a look at USDT and USDC, we can see that there's over 11% increase here since back in September. So really almost coming up here on about 4 months, October, November, December, and January, where we've seen about an 11% total expansion on the amount of stablecoin liquidity, or about $12.1 billion. And while that's not, chump change, that's definitely a substantial amount of money in the grand scheme of things. This is not the kind of typical expansion we've seen in the past. And the important thing to really focus on here, this is a chart we usually only share with the Dash report, but I wanted to share with you guys for the context here today, and just kind of show as an example chart of what kind of stuff you can get access to in our analysis. This is the USDT/USDC dominance chart. And the reason why this is important here is it showcases a few things. One, we tend to find in the last cycle that when altcoin dominance became overextended to the upside, that's usually a time where markets are correcting, dollar liquidity is flush in the market, and that's where you can find great buy the dip opportunities. This thing basically spotted every top and bottom here. Now, while we have broken out of this channel after the Celsius and BlockFi bankruptcy and FTX collapse and the acceleration into the ETF rumor from BlackRock, the important thing I want you guys watching here is that 200 week. You can just see here that the 200 week is what markets are watching for right now. And if you want to kind of view it in a different way here, right? We can inverse the chart. right? So the market is essentially paying a much bigger premium than where it was back a couple months ago per dollar liquidity. To put it in better perspective, we're paying the same price premium versus stablecoin liquidity for crypto asset prices as we were back in February of 2022 or in June of 2021. This was the first major correction as we approached kind of the high range of the last bull market, and then we had a resurgence going into November. My main point here is that is there a fair argument to be made that this could continue accelerating higher, or in this case lower on the actual chart, meaning that people could continue to pay a higher premium for crypto assets per stablecoin liquidity? Sure, absolutely. But I would watch at this point, as we've been trending sideways for over a month now in this indicator. I would recommend that you track how it reacts with that 200-day. If USDT and USDC dominance shoots back up for a good week or two off of that 200 week, then that could be your sign here that we're expecting lower prices, that markets are hungry for a correction, and that they're not hungry to continue buying up assets at this moment. The appetite's not there. However, if this breaks below, that's probably your sign for an altcoin cycle and for Bitcoin to continue accelerating higher. All right, or at a minimum, at least some continued acceleration, maybe not a full altcoin cycle. My point here being that at the end of the day, you need to keep an eye on these metrics. So in order to add this to your chart, if you guys want to, you just simply type USDT.D, and then make sure you select the dominance metric for Tether, and then you click the plus icon and type in USDC.D. So that's how you can add this chart here. But if you guys again want to get access to all kinds of stuff like this, I recommend you guys check out the Dash report down below in the description. It's a great way to link up with all that we're covering here on the channel and even go beyond the stuff we cover here into some really deep research both in crypto and in the macro. But now I want to go ahead and talk a little bit here about what's going on in equity markets and the great concentration. The first thing we need to talk about here is the signs, or the warning signs more particularly, about what's going on in the bond market or with U.S. Treasury yields. Simply put, we are seeing a major uninversion of the yield curve, which is an early stage sign of a recession to come in the next few months. We can see here on the monthly that we've had the biggest acceleration in the yield curve on inversion, 46% here, or moving essentially from minus 435 to around minus 2 here. This was the biggest acceleration since back in October. And as I've mentioned to you guys before, the more this uninverts and moves higher here, the bigger the sign it is that we're coming up on a recession. That, you know, the soft landing narrative, the idea that we're just going to be able to walk out of the woods and everything's going to be good, that is going to probably get crushed. And reality is going to start to set in. The reason I say that this is significant and why we're at this point is because the 200-day usually serves as resistance here for the good times. Essentially, as this moves lower and continues to get knocked down at the 200-week, you can continue enjoying the party. And that's what we saw throughout 2023. However, the 200-week is now starting to act as support. And you can see that this was exactly the same cue here back in 2007 leading into 2008, where we got a re-acceleration or uninversion of the yield curve out of negative territory, back in positive territory. And we saw this as well here in December of 2000 or January 2001 during the dot-com bubble collapse. So this is exactly, according to history here, the yield curve does not lie. This is one of the most consistent recession indicators out there. And while nothing is absolutely guaranteed throughout history, this has been time and time and time again your sign to essentially get ready to take profits and run for the hills, so to speak. This is why, again, I recommend that you guys be very careful going long on equities, especially big tech plays that are already well established and not seeing massive earnings acceleration. This leads me to talking about the great concentration. This is one of the biggest, I think, if not the most significant topics when it comes to equities that you guys need to keep on your radar. The great concentration is a term utilized to define not only an equity market, which has become very bloated here and very overvalued in my opinion, but beyond that as well, something that is undeniable is that we have a massive concentration of that value in a few select stocks in the stock market. So right now, if we just take a look at U.S. markets, for example, U.S. equities are valued at roughly around $50 trillion at the time of recording. $50 trillion here amongst 3,645 companies that are publicly traded. However, around 28%. Very close. Nearly 1/3 of the market. Right? Roughly 30% here. It sometimes can fluctuate a little bit. 28% of the entire equity market is in valuation of the top 10 stocks in the S&P 500. That's Microsoft, Apple, Alphabet, Amazon, Nvidia, Meta, Berkshire Hathaway, Tesla, Eli Lilly, and Visa. Just those top 10 stocks. If I were to basket in the top 20, you're going to get a very similar picture. Get very close here towards that 33% mark as you add in a couple more companies. My main point here is that while some people might say that, of course, Nick, Microsoft is worth 2.8 trillion or Apple is worth 2.8 trillion. These companies are cash-rich titans. They own so many large technology plays, whether that be cloud infrastructure, mobile devices, hardware for computers, and all types of different narratives. AI, in the case of Microsoft, that's why Microsoft is now larger than Apple. It used to not be the case, but it just recently broke being the largest technology company in the world. A lot of people would say, of course, Amazon should be worth $1.6 trillion. It's the biggest e-commerce platform. But you cannot simply just say that because X company does Y, or X company is Y, in this case it's so big or it dominates in its industry, it does not mean that the company can continue climbing forever. My main point here is that these companies need to grow in order to justify these valuations. And many of them, like Apple, are not seeing major acceleration in their earnings. They've been flat for the past few years. Their PE multiple, however, is 30. So people are currently paying for Apple right now, Apple shares. They're paying a near 30-year price multiple. So in order to actually justify the valuation, that is being traded right now, they're pricing in 30 years of forward earnings at current rates. Right? So that's betting that Apple is going to essentially, if this is seen as a fair value by this technical definition, that it needs to make $100 billion, roughly speaking, for the next 30 years. Right? So my point here is that this is just a very heightened valuation for the company and a very confident bet to be making on Apple as an entity. And my main point is that if you have this huge concentration in a few stocks, this is a better chart to kind of get a visualization of the great concentration. This is the weight of the top 10 stocks in the S&P 500 more particularly. You could see back this summer that was sitting around 31.7%. Just take a look at history here and tell me whether or not this looks healthy to you. I can only on this chart point to one other period of time where we saw such an acceleration of valuation into technology plays, and that was during the dot-com bubble. Now I wholeheartedly understand the people say, Nick, this is not like the dot-com bubble. These companies are actually making money. They are definitely well established, and they are much larger than where they were back there. Fair point. But back then, during that period of time, you had this same phenomenon. Not all of those big stocks were major technology plays or as similar to the plays we're seeing today. A lot of them were traditional giants like IBM. Back then, you had, for example, Broadcom. You had Cisco Systems. You had a lot of the technology plays that are still around today, but they were the Microsofts or the Apples of their time. They were large enterprise technology companies that were set and poised to win out during the era of the internet and the broader adoption of computers for various different types of commercial applications. Right? My main point here is that no matter what kind of argument you make, eventually this will likely cool down. We have cycles in markets here where there are periods of capital flowing from the large caps to the small caps. As new bull markets emerge, we tend to find that the market needs new leadership. And I have a feeling that it's pretty understandable here to see why that is. Because at Apple and Microsoft being right under, let's just kind of call them $3 trillion companies each, we have to get Apple somehow to a $6 trillion valuation to make a 100% return. For Microsoft, the same exact story. For Google, we need Google to be essentially now it's 1.8 trillion. We need to get to a $3.6 trillion valuation to have 100% return. Is that really possible for the next 5 years? Will the market pay twice the PE multiple it's paying now on Google? Or will it double its earnings during that period of time, or maybe a mix of the two? I really don't see that happening. At least the trends aren't showing that in their earnings reports. So this is something, again, to be very cautious of, guys, here. I'm not trying to speak in absolutes. I'm not saying it has to happen right now and that the sky's falling and that these companies are terrible, yada, yada. I'm just saying it's something you should really consider. Because I know a lot of people who look at 2023 and they see that the tech stocks did well this year. Right? That was what a lot of people bought the dip on. But it's important to understand that that is not indicative of the next decade of performance. And while these are definitely solid returns, there are going to be a lot of small and mid caps, a new emergence of sectors that are going to be the next wave of market leaders. It is the more likely probable scenario than the unlikely one. And we are likely going to see a lot of plays that are not just going to do 100% moves over the next 5 years. They're going to do 5Xs, 10Xs, 20Xs, maybe even 50Xs. You're going to see some plays that make sizable moves far beyond what the big tech plays are going to do. And the reason why is because they're coming hot off the ground. They are coming from square one here. They're not working at a $1 to $2 to $3 trillion valuation and trying to get to essentially a 2 or 4 or $6 trillion valuation. They're essentially trying to start from square one. They're high risk, high reward plays. And even if you nail 1 out of 3 trends that you bet on, one of those are going to win big time. I think the era of passive investing here in equities, in the big tech plays, or in the broad S&P 500, it's not that you can't still passive invest and do well, but if you are overexposed to the big tech plays that have been carrying those indices, you may get badly burned in the process. So I think this is, again, a very important point to consider here. This also goes back to Bitcoin as well. I know we're getting the Bitcoin ETF. I know it feels like Bitcoin is unstoppable. But again, we have to get to this point here about what's the next big narrative that could carry Bitcoin from $850 billion, which is roughly where it was at back a few days ago, going onward towards 1.7 trillion, about 3.4 trillion. I know a lot of people eventually would say that Bitcoin is going to circumvent gold, and I have no doubt maybe it could do that over the next decade or so. But I don't know if it's really going to be able to do that in this window of time. And to say that there may not be a cool down window for Bitcoin that extends that to being a 20, 30-year journey to replace gold, these things don't happen overnight. I know people believe in acceleration and that it just has to happen because we want it to happen. Unfortunately, it doesn't always work out that way. And if you have all your eggs in one basket and you're making that bet, you've got to be willing to accept the consequences of that. I'm not saying you need to diversify across 100 different assets, but have a few other concentrated bets that have that exponential upside potential, and if they flop, it's not a big deal because you have other exponential bets. If you can do that research, guys, if you can keep that mentality in your mind, you will be able to stay ahead of the markets. You just got to know where to look for it. One of the big things we've been focusing on is trying to spot those next market leader industries, and we're going to be covering them here in the channel as time progresses, but we're first mainly covering them in the Dash report, which has much more of a macro focus. So if you guys want to check that out, you can check the link down below in the description and sign up for the Dash report. Just some way you can not only support the channel, but you guys get a 20-page plus report. You get our mid-month webinar, which I actually think we're doing tomorrow. We have coming up here very soon, and outside of that as well, you guys will get access towards a whole range of resources beyond what we cover here on the channel. But the last thing I wanted to talk about is if you guys have made it this far into the video, you obviously love this kind of macro analysis of what we talked about here on the channel. We are looking to expand the creator team, the video creator team here on DataDash. If you guys would be interested to potentially help create content here on this channel covering various aspects of the market, then definitely check out the link down below in the description. You can try filling out the form. All you have to do is just create a little simple daily update video. We're trying to reach out to you guys in the community because we'd love to get people who, make it to the end of these videos, who love what we talk about, who can tolerate my rambling and perhaps have a little bit of rambling of their own to do, and would want to help, get more content out, quality research and analysis on the market for the topics that our audience cares about. But if you guys are interested, check that out down below in the description. But that's it for today's video, guys. I know we talked about a lot of different topics here, around Bitcoin and altcoins. I hope you guys enjoyed this video. If you happen to enjoy it, consider dropping a like. It's a great way to support all the content we do here on this channel. And I'll see you guys at 6 a.m. Eastern Standard Time on Wednesday. Take care, everyone, and I'll talk to you all soon.